You thought you were in control. You waited patiently, drew your zones, watched the breakout. Everything looked right. The candles, the momentum, the indicators. You clicked buy. And just like that, the market turned against you. Sound familiar? It wasn't a coincidence. It wasn't the market being cruel. It was the trap, and you walked right into it. But here's the truth they never tell you. The market is not random. It's designed, not by conspiracy, but by behavior. Patterns repeat because emotions repeat. And smart money, they've studied those emotions for decades. While you're looking for confirmation, they're creating it. While you're chasing price, they're building traps. And while you're reacting, they've already exited. The worst part, you didn't even know you were the target. But now you do. And that changes everything. Because once you see the trap, you stop stepping into it. And you start learning how to set your own. Most traders think the market is a war. They treat it like a battlefield: attack, defend, retreat, repeat. But it's not. It's a game, one that's invisible to most. And like any great game, the real rules are never written down. You watch the charts, you study the candles, you chase breakouts, time pullbacks, set alerts. You do everything by the book. But somehow, you're always just a little too late, just a bit too early, or completely wrong. And after a few rounds of this emotional whiplash, you start to wonder, is the market out to get me? But the market isn't a villain. It doesn't know your name. It's not personal. It's positional. See, what you're experiencing isn't chaos. It's not random. It's choreography. The market doesn't move because a bunch of traders decided it should. It moves when liquidity is engineered, absorbed, and released by those who understand the flow: the institutions, hedge funds, market makers. The ones who play the game on a level most retail traders don't even know exists. They don't trade the same setups as you. They don't react to patterns. They design them. While you're looking at the breakout, they're setting the trap. While you're placing your stop, they're reading where everyone else put theirs. While you're emotional, they're calculating. They play poker. You're playing checkers. But let's go deeper. These players, the so-called smart money, don't need to be right all the time. They just need to be on the right side of your fear, your greed, and your need to act. They don't need better indicators. They understand one thing: how you think. Because when you entered that confirmed breakout trade, they already saw it. Not just your order, but thousands like it. Stacked, predictable, emotional. They knew what would happen next, not because they can see the future, but because they've built systems to detect what retail traders do over and over again. You see price, they see liquidity, you see opportunity, they see inefficiency, you see efficiency, you see a level holding 3 times and think it's strong support. They see a cluster of stop losses perfectly positioned to be swept. And when price rips through that level, you're not being hunted. You're just being read like a book, because your habits, your reactions, your logic, it's all been seen before, hundreds of thousands of times. Welcome to the invisible game. And here's the dangerous part. You're not losing because you're not trying hard enough. You're losing because you're playing a game you don't know you're in. You're taught to look at patterns. They're looking at behavior. You're told to use indicators. They use order flow. You're chasing setups. They're engineering imbalance. And most traders, they'll spend years fighting price action, arguing with the market, looking for the perfect strategy while ignoring the actual mechanics of how price moves. Let me be clear. Price doesn't move because of MACD. It doesn't reverse because of RSI. And it sure as hell doesn't explode because your trend line is clean. Price moves because someone is willing to buy or sell size at a specific level and someone else isn't. That's it. Supply, demand, liquidity, intent, behavior. It's not mystical. It's mechanical. But the mechanics are hidden beneath the surface, where very few traders bother to look. Why? Because it's easier to believe the market is unfair. It's easier to blame manipulation or algos than to admit that maybe, just maybe, you're dancing in a room where someone else wrote the music and you don't even hear it playing. But here's the good news. You can learn to hear it. You can learn the rhythm. And once you do, trading doesn't feel random anymore. It feels readable. Like Daniel, a trader I mentored, he was technical, smart, disciplined. He used everything: RSI, trend lines, order blocks, even Fibonacci. But he was always one step behind, reacting, hesitating, getting whipsawed. Until one day, staring at the chart, he saw it. A huge spike in volume, but no price movement, nothing. To the untrained eye, boring. To Daniel, it was the breath before the punch, absorption, preparation. It was the first time he saw the game behind the candles. Right? From that day forward, he stopped trading surface patterns. He started watching for intent, not just what price was doing, but why it was doing it. Who was behind the move? What liquidity was being targeted? What behavior was being baited? That's the moment everything changed. He stopped chasing. He started waiting. He started listening. That's what this part of your journey is about. Not learning another edge, not mastering another tool, but seeing the game that's been playing all along, right in front of your eyes, once invisible, now exposed. And that changes everything. Before the explosion comes the silence, before the breakout comes the buildup, and before every massive move you wish you'd caught, there was a phase most traders ignored. Accumulation. You see, price doesn't just move, it builds pressure. It waits. And when it's finally ready, it erupts. But by then, it's too late for most, because most traders are reactive. They chase what's already gone. They buy after the move, not before it, because they never learned to read the signs beneath the surface. This is where smart money lives, in the invisible zone, in the shadows between movement and stillness, where they quietly accumulate while retail traders grow restless. Let's break it down. Imagine you're an institution. You manage billions. You can't just hit market buy on a 10,000 BTC position. If you did, price would spike instantly, and you'd be stuck chasing your own liquidity. So what do? You accumulate strategically, quietly, over time. You let price go sideways. You let volume die down. You let retail traders get bored, stop watching, start doubting. And while the world is distracted, you build, you absorb, you position. This is accumulation. To the untrained eye, it looks like nothing. A flat market, choppy, boring. But beneath the surface, the game is being played. It's like watching ocean currents. The water looks still. But beneath, powerful forces are pulling, aligning, preparing for a shift. And when it comes, it's fast, explosive, unforgiving. But here's the thing. Accumulation doesn't happen without absorption. Absorption is the key that unlocks the move. And most traders don't even know what it means. Let me explain. Absorption is when large players take the opposite side of aggressive market orders without letting price move. Think of it like this. Buyers keep pushing. They keep slamming the ask. More and more orders hit the book. But price, it doesn't budge. Why? Because someone bigger, smarter, is standing on the other side, absorbing everything without blinking. To most people, it looks like a pause, a stall, a failed move. But in reality, it's strategic positioning. They're not trying to push price, not yet. They're letting you bring the liquidity to them. They wait, they absorb, they build, until the moment comes when they no longer need your orders. Because now, they're ready. That's when the real move begins. Daniel, the trader I told you about earlier, he learned this the hard way. He saw what looked like a textbook ascending triangle, perfect consolidation, volume increasing, breakout imminent. He entered long, confident, and then reversal. Fast, brutal. He was stopped out within minutes. What happened? Later, when he studied the order flow, he saw it. Thousands of buy orders hitting the ask, but a giant seller was sitting there, calmly providing liquidity. Price didn't go up because every buyer was being absorbed. That wasn't weakness. That was a setup. And Daniel, he wasn't in on it. He was food. But it changed him because once he recognized absorption, he started seeing it everywhere. Before big moves, during false breakouts, inside fake support zones. He realized the market wasn't random. It was a story. And every story has foreshadowing. Absorption is the foreshadowing of the move. It's the silent warning that something big is coming, but only the attentive notice it. So how do you spot it? You look for effort without result. Aggression with no reward. Big buying, flat price. Big selling, no drop. That's absorption. And when you see it, you don't jump. You don't rush. You observe. You study how long it lasts. You wait for signs of exhaustion. You position yourself with the flow, not against it. Because when absorption ends, that's when imbalance begins. And imbalance is where the money is made. Look, this isn't just about reading the tape. It's about rewiring how you think as a trader. Most people are trained to chase confirmation, to look for obvious signals, to react to momentum. But smart money doesn't chase momentum. They build pressure behind the curtain. They accumulate when no one's watching. They absorb when everyone's confused, and then they release it all in one decisive strike. If you're only watching candles, you're missing the story. If you're only following indicators, you're already too late. But if you learn to read accumulation, if you learn to recognize absorption, you stop reacting to moves and start predicting where the pressure is building. And that's when you flip the script. You stop being liquidity and start trading with awareness. So the next time you see a range that feels like it's going nowhere, pause. Ask yourself, is this true indecision or hidden accumulation? Are we stalling or absorbing? Is the market sleeping or loading the spring? Because most of the best trades don't come from action. They come from waiting, from watching, from seeing what others miss. Accumulation is the calm. Absorption is the breath. And the breakout, that's just the final note of a song that's been playing for days. The question is, will you be the one who listens or the one who gets caught dancing too late? It always happens the same way. You wait, you analyze, you do everything right. Price breaks the level, volume surges, momentum is strong. This is it. You hit buy. And for a moment, everything feels perfect. Then the reversal, fast, violent, cold. Within minutes, your stop loss is hit. You're left staring at the screen, wondering how something so clear, so obvious, could collapse so completely. It wasn't your setup. It wasn't your timing. It wasn't you. It was the trap, a liquidity trap, designed for you to take the bait. Welcome to one of the most brutal and most brilliant tools smart money uses to survive and thrive in the markets. Stop hunts, false breakouts, manipulated moves, and if you don't understand them, you're not just at risk. You are the liquidity. Let's strip away the myth. Markets don't move just because of breakouts. They move because someone needs liquidity. And where do they get it? From the most predictable behavior in the world. Retail traders chasing confirmation. The breakout above resistance, that's not a breakout. It's a honey trap. The price spike before a dump, that's not momentum. It's bait. The quick drop below support followed by an instant reversal, that's not volatility. It's a flush. These are not glitches in the market. They are the mechanics of how the market breathes. Here's the harsh truth. Large players, institutions, whales, prop firms, they need someone on the other side of their trades. They don't place orders where there's no volume. They don't chase moves like the rest of us. They engineer environments where emotion takes over logic, and in those moments, they feed. Let me show you how. Let's say they want to go long, big size, but the market is quiet, flat. There's not enough selling pressure to buy into without moving the price. So what do? They create it. They push the price just below a major support level, just far enough to trigger all those stop losses, the ones placed neatly by retail traders trying to protect their trades. And just like that, the floodgates open. A surge of sell orders enters the market. Fear takes over. Support is broken, they think. This is the crash. But it's not. It's the harvest. Because as retail panic sells, smart money buys. Quietly, calmly, into the fear. The move down was never the real move. It was the setup. That's a stop hunt. Now, reverse it. They want to sell a massive position, but they can't dump it into a flat market without crashing the price. So instead, they push price above resistance, create urgency, trigger breakout buyers, let FOMO flood the books with buy orders. And while everyone's chasing green candles, smart money is distributing into the excitement. They're selling not because price is strong, but because you made it strong. And then once they've offloaded enough size, they pull the rug. Price collapses, retail is trapped, and the cycle continues. This is the game. This is the invisible war between those who understand liquidity and those who feed it. So now let's ask the real question. Why does this work? Because humans are emotional, because most traders don't trade what they see, they trade what they feel. They feel the rush of a breakout and think, I can't miss this. They feel the fear of a breakdown and scream, I have to exit. And smart money? They don't fight that emotion. They use it. They anticipate it. They plan around it, and they profit from it. Every time you chase, every time you panic, every time you place your stop just under the last swing low, thinking it's safe, you're showing your hand, and they're watching. Let me be clear. This is not manipulation in the evil sense. This is not cheating. It's just how liquidity works. Markets are matchmaking machines, matching buyers with sellers, matching fear with opportunity. But if you don't understand the structure behind these moves, you're not participating in the market. You're being harvested by it. So how do you escape? You change how you see the game. Start by asking, where would everyone else place their stops? Because wherever that is, that's where the trap will be set. Understand that the obvious level is the dangerous level. When you see a clear support line that's held 3 times, know that everyone sees it, and where stops cluster, liquidity forms. That liquidity becomes the target. That's why safe zones get violated. Not because the market is broken, because it's functioning exactly as designed. Once Daniel, the trader I mentored, finally grasped this, he stopped chasing breakouts. He stopped buying strength and selling weakness. Instead, he began to look for failed moves. He asked, where is the trap? He waited for the flush, the fake out, the sweep, and then, when the panic had cleared, he entered, not in the excitement, but in the aftermath. That's where real opportunity lives. Because once the trap is sprung, once the weak hands are gone, once the stops are triggered, the market is finally clean. That's when smart money makes their real move. And now Daniel does too. So the next time you see price break a level with drama, ask yourself, is this momentum or is it a lure? Are you early or are you being invited in late? Because the greatest edge isn't in predicting the move, it's in avoiding the trap. This is the part of the game no one teaches. But now you see it. Now you know. The breakout isn't the beginning. It's often the end. So stop being liquidity. Start understanding it. Start seeing the game for what it is, not what it pretends to be. Because once you stop falling for every candle that moves fast, you start moving with purpose. And that's the beginning of trading with awareness. Most traders stare at charts like maps. They draw trend lines, plot Fibonacci, paint support and resistance zones like battle plans. But here's the problem. They're reading the map upside down because the chart isn't just price. It's not just highs and lows, patterns and pullbacks. It's a living, breathing record of where traders committed and where they hesitated. And the one thing that reveals this better than anything else? Volume. Not volume over time. Not those bars at the bottom of your screen. I'm talking about volume at price, the volume profile. The real map. The map that shows not where price moved, but where decisions were made. See, price alone is a lie. It shows you the result, not the struggle. It's the surface of the water, not the currents underneath. But when you add volume to price, you start seeing what the market is really made of. You start seeing the layers, the footprints, the memory. Let me explain. Every level on a chart isn't equal. Some levels are loaded with volume, trades stacked upon trades. Others are hollow, barely touched, passed through quickly. The volume profile shows you this. It tells you where the market stopped and thought, where participants argued, battled, negotiated, and where it didn't. That matters a lot because high volume levels, called high volume nodes, are areas of agreement where buyers and sellers reached equilibrium, where they said this price is fair. And low volume areas, low volume nodes, that's where the market rejected price. Okay, those zones, they're like air pockets. Price can fly through them with very little resistance. And this is where everything changes because now you're not just watching price move, you're watching how easily it moves, where it wants to go, and where it wants to avoid. Let me show you how Daniel used this. He was stuck again, taking trades off support, selling into resistance, getting chopped in tight ranges and run over in breakouts, until he stopped looking at candlesticks and started studying volume. And suddenly, something clicked. He noticed that every time price reversed sharply, it was doing so at a high volume level, a place where a lot of traders had entered. Why? Because these areas had memory. People remembered their losses. They remembered their entries. They remembered their pain. So when price returned, emotions returned too. Fear, hope, greed. And that emotional memory creates friction. That's why high volume nodes often act like magnets. Price gets pulled into them and stalls. But here's the kicker. It's not always about rejection. Sometimes smart money uses those zones to build again, to reload, to accumulate in plain sight, because in high volume areas, they can do so without moving price too much. That's the trick. And Daniel, he stopped blindly trusting support and resistance. He started asking deeper questions. Is this level supported by memory or just by pattern? Is there enough volume here to hold a move or to absorb one? Is this a price the market cares about? And when he didn't see volume, he took it as a warning, because low volume areas are dangerous. They may look clean, they may look obvious, but they're slippery. The market doesn't like to stay in places where it hasn't spent time. That's why breakouts through low volume areas are often explosive. There's no one there to stop them, no memory, no resistance, no friction. So Daniel began trading between the volume, not against it. He'd wait for price to revisit a high volume zone. Watch how it reacted. Was it accepted or rejected? If it stalled, absorbed, and coiled, he knew someone was preparing. If it sliced through, clean and violent, he knew the market had made up its mind. He wasn't trading price anymore. He was trading structure. And that's what the volume map reveals. Structure, where things matter, where decisions cluster, where emotions were recorded. This isn't theoretical. A 2022 study from the Journal of Financial Markets found that over 70% of major reversals happen at high volume nodes, and over 80% of impulsive breakouts happen through low volume zones. That's not coincidence. That's market memory in action. So let me ask you, have you ever bought at support only to watch price fall like it didn't exist? Have you ever sold resistance only to see price tear through like a freight train? It wasn't the level that was wrong. It was the lack of commitment at that level. No volume, no interest. That's the truth. The candles won't tell you. And once you start using the volume profile, you stop trading like everyone else. You start asking smarter questions. And where did real commitment happen? Where was volume building behind the scenes? Where is the path of least resistance? And that's the edge. Because smart money doesn't draw trend lines. They look for liquidity. They look for imbalance. They look for zones where they can operate without exposure. And those zones, they're almost always marked by volume, not flashy candles, not fancy indicators, just evidence. So start watching the real map, because once you do, you'll stop being surprised by the market. You'll start reading it. You'll start understanding when to stay out and when to lean in. And you'll start to see that trading isn't about prediction. It's about preparation. And the volume profile, it's your preparation tool. It's the terrain map beneath the fog. It doesn't show you where price will go, but it shows you where it's likely to matter. And in trading, that's everything. They teach you patterns, head and shoulders, double tops, flags, pennants. They tell you the market is a machine, logical, clean, measurable. But they don't teach you the truth. They don't teach you the cycle, not the one in the textbooks, not the one printed on posters and trading courses. I'm talking about the real cycle, the one institutions live by, and retail traders are constantly trapped inside, because the market doesn't move in straight lines. It doesn't respond to your favorite indicator. It breathes in phases, and each phase is psychological. It's not a strategy, it's behavior. It begins with accumulation, not flashy, not exciting, just slow, tight, controlled price action. Low volatility, mixed signals, choppy candles. Most traders avoid it. It's boring. This market has no energy. Exactly. Because smart money is building quietly. They accumulate in silence, while the world sleeps, while YouTube screams, "Don't trade this chop." But it's in this silence that the seed is planted. Why? Because they need to load size without exposure. They don't want attention. They don't want confirmation. They want your boredom. So while retail traders walk away, institutions are buying, slowly, patiently, strategically. This is when volume rises quietly, but price goes nowhere. That's not indecision, that's intention. Then comes the shakeout. One violent move, a sudden drop below support or a rip above resistance. It doesn't last, but it doesn't need to. Its only purpose is to clear the board, to flush out the weak hands, to trigger stop losses, to trap breakout traders, because smart money doesn't just build positions, they build conditions. Conditions that clean the chart, conditions that remove excess noise, conditions that prepare the path. And then, when the stage is set, comes the markup. That moment traders dream about. The explosive move, green candles, momentum, FOMO. Retail jumps in. This is the breakout. This is the move I've been waiting for. But they're late, because what looks like the beginning to most is simply the middle. The positions were built already. The risk was managed already. The real profit was already locked in. Now it's about exit. So while retail buys the breakout, smart money begins to scale out, but they don't dump everything at once. That would crash the price. They need liquidity. So they wait. They let the excitement build. They let social media fuel the narrative. They let newsletters call for 100K Bitcoin or tech stocks to the moon. And when the retail crowd is fully engaged, they begin distribution carefully, quietly. They sell into strength, they offload into demand, and all the while, price keeps rising or moves sideways just enough to avoid suspicion. Retail still believes, but smart money is already gone. Then comes the break, the moment no one sees coming. The news won't explain it, the chart won't warn you, but it happens fast. Volatility returns, support fails, stops hit, traders panic. This is the markdown, the final stage, the collapse. Not because something broke, but because the cycle completed. The market isn't crashing, it's resetting. Because once the distribution ends, once the inventory is offloaded, the market doesn't need to hold anymore, and so it drops. Not by accident, not as punishment, but as preparation for the next accumulation to begin. And so the cycle repeats again and again across every market, every asset, every time frame. But here's the tragedy. Most traders only participate in one part of the cycle, the middle. They buy the excitement, they sell in fear, they live in the markup and die in the markdown because they don't recognize the beginning and they never see the end coming. Why? Because no one teaches them this. Because most education is built on indicators, not behavior, on entries, not phases, on signals, not structure. But once you see it, once you recognize that the market is just human emotion in motion, everything changes. You stop chasing, you start waiting, you start asking real questions. Is this price action building or distributing? Is this excitement or exhaustion? Is this a beginning or the final breath before reversal? Because when you align yourself with the cycle, you stop forcing trades. You stop needing confirmation from the crowd. You become patient, deliberate, strategic, like the institutions, like the builders of the cycle itself. That's when trading transforms from gambling to reading, from hoping to observing, from reacting to positioning. So let me ask you, have you been fighting the market or have you simply been trading the wrong part of the cycle? Because the market doesn't care how hard you work. It doesn't care how smart your strategy is. It only rewards those who understand the rhythm. And now you do. So the next time you see price consolidating, ask yourself if it's really just chop or if you're witnessing the start of a move that's weeks in the making. The next time you see a breakout, ask who's buying and who's selling into that buying. And the next time you feel that rush of momentum, pause, because the best traders aren't chasing the move. They're already there. They waited, they prepared, they understood the cycle you were never taught. Now that you know it, you don't just see the market differently, you move differently. And in trading, that makes all the difference. You've seen the game, you've watched it unfold, silent, calculated, brutal, the stop hunts, the traps, the manipulations masked as momentum. And maybe for the first time, you're starting to see the truth. The market wasn't unfair. It was just one step ahead of you. But now, you know. And when you know how the game works, you don't have to be its victim. You can fight back. Not with rage, not with revenge trades, not with doubling your lot size to get it back. No. You fight back with understanding, with patience, with discipline sharp enough to cut through the noise. Because here's what most traders never realize. The market isn't your enemy. Your reactions are. It's not the price that beats you. It's the voice in your head saying, I missed it. I have to get in now. It's breaking out. I'll just take a small position. That voice isn't strategy. That voice is sabotage. And if you want to fight back, truly fight back, you have to start by going quiet. Silence the noise, the news, the Twitter feed, the fake urgency that tells you trading is about being fast, because it's not. Trading is about being aligned, not just with the market, but with yourself. So here's how you begin. You stop chasing price and start chasing context. Start asking, where am I in the cycle? Is this accumulation or distribution? Who's on the other side of this move? Because if you don't know who's in control, you don't know what you're trading into. Most retail traders walk into traps because they only look at patterns, candles, indicators, entries. But smart traders, they look for intent. They ask, why is price here? Not just what is price doing? They wait for the story to make sense, not just the chart. And when it doesn't, they stand down because waiting is part of the